Hello, investors, traders, and future degenerate gamblers. My name is Beast McFeast, and this is the first video to introduce you to terms that we're going to need to know to discuss trading and investing stocks and options, and maybe futures. Um, there's going to be several videos in this series because there's a lot more than 10 terms you're going to need to know. I'm going to try to discuss these in their by the book definition and how they're frequently used because these don't necessarily match up. So let's jump right in with a security. Securities are tradable assets, which come in three main types: equities, debt, and derivatives. For most people who are interested in trading or investing, the first security you're going to play with is a stock or ETF. These are listed under tickers, which are the letters that abbreviate their names. So, like when you want to buy, United Wholesale Mortgage Company, you don't type that in to buy it to your broker. Type in UWMC. That's your ticker. That's your equity. That's one of the equities that you can trade. Moving forward, who manages securities? In theory, the Securities and Exchange Commission manages and ensures a fair market for everybody. In practice, not always the case. A lot of people are pretty upset with the SEC right now for regulations regarding short selling. It's 2021, and there's been issues with short selling of GameStop and AMC, and these are upsetting a lot of people because there's discussion of whether or not the SEC is turning a blind eye to the counterfeiting of shares. But ideally, the SEC has three main goals. They protect investors, they maintain a fair and efficient market, and facilitate capital formation. Capital formation is the ability for smaller companies to get into the market, become listed, and sell shares to raise funding for whatever they want to do. So the first type of security most people are going to play with is stock. They're essentially little sections of a company that they're selling to you to hold on to. And when you hold these, you hope that they go up in value or pay a dividend, or in the best case scenario, a combination of going up in value while paying you on the way up if you're holding long term. In the short term, traders, opposed to investors, traders just don't much care for the dividend except for how it affects the value of shares of stock. Bonds are a debt security. You can get government bonds, or company bonds. Those are really the only ones you're going to buy, probably. Essentially, they're a loan that you make to whatever entity you're buying the bonds from. So, I don't know how many of you out there have come across like a physical bond. You can find like a government EE bond, which looks like a funny dollar bill, really. Or funny $500 bill or $1,000 bill that talks about like the interest rate it pays out and how many years it'll mature for, and you can go online and calculate what these are worth. So when you get a bond, you put your money aside in the bond, and every so often they'll pay a coupon, a percentage of interest to you, an amount of interest to you. I don't know why they call them coupons, but every so often they pay out. Most of the ones I've traded in pay out twice a year. These are viewed as very safe assets to trade or hold on to, at least the government bonds. Now, some bonds pay more than others, and what that tends to be based off of is how safe they are. So if you're willing to take a big risk, you can get a high interest rate on a bond, relatively high compared to some safe bonds. So let's say you've got a company like Coca-Cola who's just not going anywhere. I mean, they've been around forever, and they're probably going to be around forever. If they wanted to issue bonds, they'd pay a pretty crappy interest rate, 2, 3, 1%, in that type of range. But if you have a more risky bet, I can't think of one off the top of my head, but just a more risky company that's having some trouble, they will release bonds at a higher interest rate, and you can benefit off that if you're willing to take that risk. A lot of bonds have stipulations that the company can buy them back early if they get their accounting right and they can buy back these bonds, they'd like to do that so they don't have to pay this interest rate to you. Derivatives are a type of security whose value is derived from an underlying asset. Essentially, when you're buying and selling derivatives, you're trading contracts that gives the buy side and sell side certain responsibilities and privileges based off of what you're trading. So these will be your options and your futures contracts. For most of us, that's probably going to be the limit of the derivatives that we trade. The price of these contracts can vary over time, and they have certain qualities that make them appealing to certain people. So if you're buying derivatives, you can often leverage yourself, so exert more control than your money would typically allow, because you're not trading the actual security, you're trading a contract. We're going to get into that later in more detail in future videos after I get through the terms we're going to need to know to discuss these intelligently, because a lot of derivatives essentially be considered complex investing. We're talking trading in options and futures, and for a long time, these weren't available to the average consumer. With the advent of internet trading and cheaper and cheaper trading brokerages and platforms like Robinhood and Webull bringing down the price, these became accessible to everyone. You can trade these as easily as you could shares of stock now. So when you want to buy stock, you buy shares. The shares are the discrete units of a company. The company can release as many or as few shares as they want. When a company releases shares, they release a certain number, and the company has a certain value, which is the total combined value of their shares. That becomes their market cap. So you can go and buy one share of, I don't know, Berkshire Hathaway for like $200,000, or you can buy a share of Sundial for 75 cents. They vary widely in price. And now you can buy partial shares. So if you don't have 200,000, you still want to get on the Berkshire Hathaway train, you can buy a percentage of a Berk share. So let's say you wanted to buy Tesla, for example. You're looking at currently $745. This is September 8th, 2021. The market's not happy today, but Tesla's doing pretty well. It's at $745 a share. Now, things that can happen to your shares. Shares can be split, which will turn one of your shares into multiple shares. You might get a share, they split each share in half, so one becomes two, and those two would be half value. Or you could go from one share to 3 shares, and each of those shares would be a third of the value. I've seen these go up to like 8 shares to 1. So you turn your 1 share into 8 shares. So this will essentially split how many shares you have, but maybe not necessarily influence the price directly. But a lot of people like to try to get in on these splits because it gives them some options to trade options in the future. Reverse can be true, where let's say you buy 1,000 shares in a penny stock, and the company says, all right, we got too many shares out there and our value is too low. Let's cut the number of shares down to half or a third. And again, this shouldn't directly influence the price of what you're holding, but the market responds different ways to these things. Generally, when shares are split, people like to buy in ahead of time because it kind of creates a little feeding frenzy. And when shares are reduced, doesn't necessarily make people the happiest. So dividends is one of the ways I've talked about profiting off of your shares. These are payments to people who own a share or multiple shares or a percentage of a share, and they're paid to you in proportion to the number of shares. Now, when you pull up information on a stock ticker, you go on Google or Yahoo Finance, are pretty easy to use. You'll see how much the dividend is if they pay one and how often it's paid. And you'll see it often described as a yield percentage, which is not the most accurate way to do it. I mean, it's fine. It's a good estimation, but let's say you get something like the ticker QYLD, which pays about 12.5% dividend a year, which is really high. It's a very high dividend to get. You look at that 12%, it looks great. So you think to yourself, oh man, if QYLD were to double in value, I would get twice the dividend because it's still 12%. Well, that's not the case. If QYLD goes from, I think it's at like 22 now, and it doubles to 44, your dividend yield, if you buy in at 44, will be reduced by half. These are actually set amounts released. So QYLD gives you like $2 a year, about $2.20 a year, not necessarily 12%. But it's an easy way to describe it. And then the yield refers to the current dividend. So if you throw all your money into something right now, and you're looking at the dividend yield and you hit buy, and you buy 1,000 shares of something with a let's say a 3% dividend yield, then yeah, that's your dividend yield. But if you wait tomorrow and the thing drops in price significantly, then the yield as a percentage of total value would go up. Dividends are a trade-off that you make for growth generally, or essentially in all cases. I can't think of one where it wouldn't be, because you're taking money that the company could spend on reinvestment and distributing it to all of the shareholders. Now, in some industries, a company gets to like the biggest size it could. It might saturate the market to where they're really not going to grow too much. So we're going to go back to the example of like Coca-Cola. All right, everyone essentially knows that Coke exists. You either drink it or you don't. They can occasionally release new products, but the cost to them is relatively low to do that. So they like to release a dividend to shareholders to entice them to buy and hold more shares, because that increases their value and lets them borrow against or release more shares at a higher value if they need to raise money. So if you want to buy shares on the market, like New York Stock Exchange or NASDAQ, you need to go through a broker. Now, these used to be people that you would call up or write a letter to and tell them to make a trade on your behalf. Now, you can go online, open an account with a broker. So you might go to like TD Ameritrade or E-Trade or Robinhood or Webull or Tasty Trade. There's dozens more, and they vary by country. You open an account, you deposit money, and then you can start trading. Brokers will do some things to like limit the amount of risks you can take to ensure that you don't, I don't know, if you deposit $2,000, you don't go and do something that can cost you $200,000, ideally. There have been instances, rarely, where people do over leverage themselves and take a lot more risk than they can actually afford, and it costs them a great deal of money. And if they can't pay, the cost is passed on to the broker. So the broker protects you to protect themselves. You really want to ensure that your broker is trustworthy, so go online, do a little bit of research and see like, hey, is this a highly rated broker? Does their user interface look like something I would like to use? If you're just starting trading for the first time, I'd go Webull or Robinhood. You use them on your phone. Robinhood's been getting some bad press lately for some issues early in 2021. And they might not give you the best prices on things by a few cents here and there, which isn't a huge deal, like a few cents per share lost, unless you're buying a lot of something. And we're going to get into that more later. It especially becomes a problem with options trades, where you're often trading very many contracts at a time for more complex investments. So when we want to discuss our position on things, or the nature of the market, or just how things are going, we would use the term bullish to describe things that are going to go up in value. So if you buy shares in a company, your position would be bullish. You believe they're going to go up in value. Otherwise, you wouldn't buy those shares, clearly. Or if you're holding on to shares and, something changed, you might dump them because you're no longer bullish. You become what we call bearish. Bullish can also refer to the nature of a financial tool. So when we get into options trading, there are call options, which are necessarily bullish. They only help you profit if the stock goes up. If you think things are doom and gloom and everything's going to go bad in the market, your outlook on the market is bearish. If you buy a financial tool that goes up in value, when a market or company decreases in value, that's a bearish financial tool. Bullish is positive, bearish is negative on something. If you like this video, please like and subscribe. I'm going to produce more videos in this series to discuss more and more complex terms as we go. But to discuss trading in any reasonable way, we really need to have these basic terms down. So there are going to be several of these that aren't very complex. Check my channel for more trading strategy and advice on how to use financial tools. Thanks.